I think what's important is it's not a free-for-all. You need to balance the cost of data, the number of data sources, the quality, the predictive power. It needs to be intuitive and accurate and also socially acceptable by regulators.
You're listening to Rethinking Insurance, a podcast series from Willis Towers Watson, where we discuss the issues facing P&C, life, and composite insurers around the globe, as well as exploring the latest tools, techniques, and innovations that will help you to rethink insurance.
Hello and welcome to our Rethinking Insurance podcast. I'm your host, Michael McPhail. On today's show, we'll be discussing some key issues and trends that are impacting commercial lines insurers. We have two wonderful guests today, Jeff Van Kley and Nancy Serio. Jeff is the pricing, product, claims, and underwriting lead for the Americas and is based in Chicago. Nancy's a director based in Hartford. She's not an actuary. She's an expert in underwriting solutions, and she'll be providing that perspective today. Hello to both of you.
Hi, Michael. Glad to be here.
Hi, Michael. Glad to be here. Thank you for having us.
Absolutely. So, typically in the past, we've started these shows by asking our guests, if we were to Google something about you, what would you find? But we're going to take a break from that today, try something a little bit different. So I would like to know from each of you, what do you like to do outside of work at Willis Towers Watson? And start with Jeff.
Yeah, I like to try to stay in shape, try to travel a little bit as COVID allows, and root for the Chicago Cubs when they're playing, but they're not playing right now.
And Nancy, what do you like to do outside of work?
I love to travel and see sports. I just recently returned from Acadia National Park, an amazing park locally. Looking forward to traveling a lot more once COVID settles down. And my passion for baseball, especially the Boston Red Sox. What about those Red Sox last night? Leveraging those analytics pretty well. By the time you hear this podcast, though, we'll see if the analytics worked.
Yeah, right on. I didn't grow up in Massachusetts. I grew up in Texas. Huge Houston Astros fan, but I've always had a soft spot for the Red Sox, so I won't be too disappointed if they're the ones that make it all the way. All right, well, I'm gonna head into the rest of the show here and start getting our experts' thoughts on all things commercial lines. So, commercial lines insurers, they're increasingly adopting AI and analytics. I'd love to hear from each of you on what you think's driving this and how insurers are applying these techniques. I'll start with Jeff.
Yeah, I think this is being driven by multiple forces. New players from the insurtech space, as well as venture capital funded startups, are ramping up the competition at the moment. And at the same time, social inflation and increases in loss costs have prompted insurers to invest more in the identification of the better risks in the commercial space. All of this adds up to increased competition for better risks within commercial classes. Insurers are applying these techniques by gathering and capturing more data on their insureds, as well as searching for external data sources via the internet or otherwise. We've all heard of people web scraping using Python or whatnot to gather more information. This data is then used to create generalized linear models, machine learning models, or other advanced predictive models to identify more profitable risks to insure. Nancy, I know you had some thoughts on this topic.
Yeah, I think what's important is it's not a free-for-all. You need to balance the cost of data, the number of data sources, the quality, the predictive power. It needs to be intuitive and accurate and also socially acceptable by regulators.
So both of you mentioned data sources. I'd like to dig in a little bit further on that. So can you describe what new data sources are commercial lines insurers leveraging? Whether that's to improve underwriting or claims outcomes. Can you go a little bit more into what these data sources are?
Yeah, I'll go into that a little bit. I think I'm probably going to only end up scratching the surface here because there's so much going on. Depending on the line of business, many external data sources are accessed. The internet obviously has a wealth of information that can be scraped and utilized. Additionally, property risks can be evaluated using satellite photos, drone taken pictures, people driving by and taking photos, or other digital media to evaluate the condition of the roof and the overall property and the surrounding area. Also on the claim side, background data on claimants' vehicles, properties, and insurers can be utilized as indicators of potential fraud, as well as predicting the ultimate value of claims. Finally, claims analytic data can be used to automatically steer claims to the appropriate area where the claim could be best handled, whether that be fast track claims, back to a litigation specialist area, or to high exposure committees for further discussion. Nancy, I know you had some other thoughts on this as well.
Yes, I mean, there's a lot of vendors out there today, and a lot of vendors are commenting on how they've got the perfect solution to append. Some are saying, hey, we've got 50 variables in total at the address level related to crime, whether it be crime, weather, climate. So it's sifting through the different sources of data, and as we had mentioned, is balancing the number of variables that carriers will ultimately use. We are seeing an increased use of external variables by carriers, especially property crime, hail severity, seeing more use of wind with all the natural disasters we've had and stuff like that. So increased use of wind. Carriers are using zip code mapping for these types of variables. We're seeing that they're using a lot of different variables, but ultimately they are using fewer variables ultimately in their actual model. For example, working from home is a variable that some carriers are using now in burglary for their demographics versus the 50 variables that are available. So they're using a smaller number of variables that they feel have stronger predictive power.
So just as a kind of follow-up to that, are you starting to see commercial lines carriers using external data sources to the extent that a personal line carrier would?
Yes, we're seeing use of looking at a lot of different variables, but ultimately what variables actually end up potentially in a predictive model ends up being like a handful of variables.
Okay. I'm going to switch gears a little bit here and talk about what's been happening in the world over the last 18 months, which is the COVID-19 pandemic. Obviously, this has had a huge impact on many industries, including the insurance industry. So, I'd love for each of you to speak on the impact that COVID-19 has had on insurers' efforts. And, furthermore, what I really mean by that is, has the pandemic accelerated their initiatives, or has it been an obstacle to progress? Jeff, why don't you start it off?
Yeah, no, thanks, Michael. It has had so many impacts. And we talk to a lot of different carriers, and you can sense different impacts when you talk to them. It's had several impacts, not limited to disruptions in loss experience, turnover in data science analytics teams or other leadership teams, lack of in-person collaboration, possibly contributing to longer development time, and budget room created by a lack of travel expenses. Obviously, the expense equation has changed as well. Overall, has made budget dollars available for investment, but between the data disruption and the continual turnover of staff in a lot of companies, progress has proven to be challenging, as well as just the change in the general work environment that we're all living and working in. The insurtech disruption, as well as venture capital startups, have contributed to a spike in demand for analytics talent, making assembling and maintaining an analytics team very difficult. And as I said before, the lack of in-person collaboration, it's been hard over the last 18 months to gather in rooms and whiteboard and really brainstorm together in the same way we used to. So we've had to adapt via technology to try to collaborate as best we can. My personal opinion is it never quite replaces the getting together in a room and whiteboarding everything. So that's proven to be quite a challenge.
Yeah, and you really hit on a lot of aspects of the environment and how uncertain it has been. Insurance is already always uncertain, but this has just added a bunch of uncertainty on top of that. Nancy, could you go into some other challenges that insurers are facing in this environment?
Sure. A significant issue is the talent issue. The turnover, the onboarding, the training, especially modelers are being recruited by other industries, so there's significant shortage. The underwriting talent shortage is huge. About half of underwriters are retirement eligible. So there is definitely a significant demand for underwriting talent and actuarial talent and modeling talent. And a lot of this talent that was traditionally in the carrier or consulting space is moving to other industries. whether it be retail or, technology. So there's been huge disruption. The other area is significant disruption, both commercial lines and personal lines, and ourselves, is the supply chain disruption and general inflation. The impact of whether it be the cost of plywood or the cost of getting windows and all that impacts both personal lines and commercial lines. So the cost of claims are increasing, and business interruption, all those types of areas are going to be having a significant impact from the supply chain disruption that's happening across the world right now.
Yeah, one thing I was curious about, you talked about claims inflation, you talked about the talent issue, which absolutely you can see that impact on the insurance industry. But one thing that's very unique that's happened over this last 18 months is obviously we have all these people working from home. How does that impact cyber coverage? Are insurers changing how they approach cyber coverage?
Yes, we're seeing carriers putting clarity on coverage. So they're either explicitly excluding it or affirming coverage, versus some carriers in the past would be silent on it. So we're definitely seeing that. In the cyber market, the terms and conditions, the pricing, whether it be VPN connections and all the requirements to ensure the authentication, there's a lot more questioning of that by the underwriters at the carriers, and restrictions in terms and coverages. So we're definitely seeing that impact cyber. The other area that is very uncertain today for all of us, both in the commercial and personal line space, is climate change also. We all, the impact of fire, water, wind, flood. It's very unpredictable right now, so it makes it challenging to price for it. So that's a big challenge that everyone is facing today. And as we all know, the uncertainty of COVID and mental health, that hits multiple lines of coverage, whether it be workers' compensation, general liability, employment practices, D&O. What's the long-term impact of COVID and mental health?
Yeah, that makes sense. Thanks, Nancy. So, kind of along the lines of long-term impact of COVID and how insurers prepare for the future. In terms of comparing and contrasting commercial lines and personal lines, what are the main differences that you're still seeing in the industry today?
I think over the last several years, there's been a pretty large gap between predictive analytics use and personal lines and commercial lines, and that has to do with volume of data, homogeneity, and other factors. So, when we're talking to clients, there's been a bigger push towards using analytics in the commercial line space to kind of catch up, for lack of a better term, to the personal line space. And Nancy, I know you had some thoughts on that as well.
Yes, our 2021 Advanced Analytics Survey really saw a significant uptick in commercial lines, especially in the specialty lines, such as travel, excess property, and employment practices. Those were areas where we saw significant uptick in use of advanced analytics. We are seeing an increased use in traditional commercial lines, small commercial, commercial auto, general liability, BOP, and also commercial property. That seems to be a significant increase in number of carriers that are looking at advanced analytics. And that's the results of our survey are consistent with what we're seeing in recent filings of carriers trying to get approval in the commercial line space, including middle market and small commercial.
To close us out here, what should business leaders be tracking and preparing for the rest of this year and into 2022?
That's a fantastic question, because obviously when we led into 2020, we were planning for a 2020 and a 2021 that were entirely different than what turned out to be. As we move forward, we've got to think about the new normal and what things are going to be like moving into 2022 and beyond. As we look back, we have to kind of take 2020 data, throw it out as kind of anomalous, evaluate 2021 as a gradual move back to normal, and then hopefully 2022 we achieve normalcy around the world. Two major focuses for management to focus on is probably data capture / utilization, and then technology and automation. The companies that invest heavily in really understanding the risks and have more data will win competitively. And I think we touched on that a few times today about the gathering of data and the real effort to utilize that data. And this is especially true in a time of claims cost escalation. We talked about climate change. We talked a little bit about social inflation. New entrants into the business are thirsting for data and information about potential risks as it has incredible value. Carriers have been in the space for a while, have to leverage their experience and fend off the new competitors as best they can, as new competitors don't have the history on the risks. And then technology and automation, that becomes really important in this area of increasing costs. It'll lead to speed to market, which is extremely important when trends unexpectedly increase. Leveraging data quickly to enable the approval of rate increases can save millions of dollars on the loss ratio side, as well as saving hundreds of thousands on the expense side if you're more efficient in process. So that's kind of what we see going forward, at least as it relates to analytics and commercial lines in the actuarial world.
Thank you for that, Jeff. Well, that's going to close us out today. I really appreciate both Jeff and Nancy joining us. And I just thought I'd give you each a chance to have a few parting words. Jeff?
I just want to thank everybody for joining today. I think it was a fantastic discussion and hope people find value in it. And as I said a little bit earlier, I'm hoping for quite a bit more normal 2022 and beyond.
Absolutely, Jeff. We're all hoping and praying for a normal 2022 so we can all get back to the way it was and better predict the future.
All right. Thanks to Nancy, Jeff again. And thanks for our audience for tuning in. And we'll see you next time on the Rethinking Insurance podcast.
Thank you for joining us for this Willis Towers Watson podcast. For more information, visit the Insights section of willistowerswatson.com.